Right, guys, welcome back. So, in the last session, what did we see? I think we are done with 5 sums, right? Now, let's start with the sixth one. Take sixth question, Anna. This is also ESOPs with a cash alternative. Same concept. I think the earlier sum we have done based on same concept only, if I'm not wrong. Not this one. Here. Yeah. Third illustration we have done already with the same concept. So, it's pretty much the same sum, same kind of a model. Okay. Right. Let's move on. Tata Industries issued share-based options to one of its key management personnel, okay, which can be exercised either in cash or equity, and it has the following features. Number of cash settled shares, that is SAR obviously. Number is given, as you can see the word number. That's why I've written 74,000 numbers over here. Service condition 3 years. Option 2, you've got number of equity settled shares of face value, which is 90,000. So naturally, when it comes to equity settled, it will be more in number because it will be with restrictions, right? Cash SARs will be without restrictions, therefore it will be less in number. This we already know, right? Conditions, service condition is 3 years, okay? That will apply to the employee who has to be in service for 3 years. Restrictions to sell will be 2 years. Now this 2 years restriction will be only for equity settled shares. It will not be for cash settled, right? Fair values, equity price with a restriction of sale of 2 years. Okay, separate that restriction, fair value should be there, it is given. And then fair value at the grant date without restriction, this will go for SAR, okay? And different fair values at the respective dates, 2000, 2001, 2002, or 20x0, 20x1, 20x2. All we have to do is pass journal entries, right now. Same model, guys. Actually, you guys can do this on your own, but anyway, we'll do it together. So what you guys need to do is that just read the question. I'll give you 30 seconds times. We'll start solving. You got 30 seconds, take it down, and after that we'll start solving, okay? Alright, guys, done with your reading? Finished, huh? Right. So let's start solving, Nana. This is illustration 6. Alright, so what is the first one that we need to do? We need to find out fair value on the grant date with respect to equity settled as well as what cash settled options, right? So let's find that out. First, fair value on grant date of equity settled options, or you can also call it as equity options, your wish, Nana. Okay, so what is the fair value on the grant date with respect to equity settled? Okay, so the fair value with the restrictions is 115 into number of shares with respect to equity settled is 90,000, because we know that it's gonna be more, right? That's it. That should give you your fair value. 115 into 90,000. 1 crore 3 lakhs 50,000. All right. What is the next thing I need to do? Fair value on grant date of cash settled options. So what about cash settled options? You'll take fair value without restriction. Fair value without restriction is how much? 135 into number of shares will be less. Obviously, it will be 74,000 when compared to equity settled. So 135 into 75,000, 74,000. Anybody can give me the number? Right. 99 lakh 90,000. 99 lakh 90,000. Yes? Okay. Now, according to our steps, this fair value of the equity settled option should be greater than fair value of the cash settled option. To that extent of the difference, we'll take it as a equity option fair value, correct? Chalo. Because it's a kind of compound instrument only, na? Because you have got, you can choose either of one, right? Chalo. So, fair value of equity component is equal to 1 crore 3 lakh 50,000 minus 99 lakh 90,000. That is equal to how much you get, Nana? 3 lakh 60,000. All right, all of you have got this. Chalo, easy peasy. We are done with the basic calculation. Now we will do accounting based on SAR only, right? So we know the concept. We'll do accounting based on SAR only. Later, if the employee chooses cash settled option, then we are very happy because we have done accounting based on SAR and we'll be having SBP liability. But all of a sudden, if the employee chooses equity option, then we'll have a problem. Then we have to shift all the way everything that we have created in SBP liability to what SBP reserve. From there, we need to issue the equity share capital as well as securities premium. So you know all these things, right? We have already discussed enough number of times. So let's start solving. Chalo. The first date will be what, Nana? You can see the question over here. 20x0, right? Right, Nana. So 2020x0. So we'll be taking it as 31st December. Okay. Right. Because there is no information in the question. Moreover, your ICAI has done it based on 31st December, which means your normal calendar year as the financial year. So we'll be going with that as well. So chalo. 31st December 20x0. That is the first date. So on this date, what we gonna do? Everybody. Cash settled option expense as well as we need to take what? Yes, equity settled option. Right. Now, equity settled option expense. Actually, we need not do this separately. Only for this year, we'll do the calculation separately because anyway, it's a simple calculation. Next year onwards, we'll be doing the entry directly. Okay. No need to do separate calculation. Anyway, equity settled option expenses. So, what is the total equity settled option expense that you have to create over a period of 3 years? 3,60,000. So, obviously, per year, it's going to be how much? Hello? Very simple. 3,60,000 into 1 by 3. Obviously. Correct? So, which is equal to how much it comes? 1,20,000. Very good. Easy peasy. Next, the next one that we need to calculate is cash settled option expense. This is also very easy. If you look at the cash settled option expense, how much, Nana? You have to take the latest fair value. So what is the latest fair value that you've got? 138. Now you might be thinking, sir, usually the formula is number of employees into number of options per employee into fair value of the option on that particular year when it comes to cash settled, right? But the number of employees is just one. If you look at the question, of its key management personnel. So there is one major guy. So therefore, we need not worry about number of employees over here because it is all about to one of its key management personnel, right? So wo to gaya, right? So what is left over for us in that case? Number of employees into number of options per employee. That anyway we know, which is 74,000, right? So let me put it then. Number of options per employee, which is 74,000. Okay, into fair value of the option at the end of the year when it comes to SARS, which is 138, which is the fair value per 20x0. Okay, into naturally into what, Nana? Vested period completed 1 divided by total vesting period 3. Vesting period completed is 1, total vesting period is 3, minus previous year. Did you recognize any expenditure? No, nothing, 0. So that is equal to 74,000 into 138 divided by 3, right? 34 lakh 4,000. So this calculation is pretty simple. We can also do it directly. Anyways, so now what will be your entry, Nana? Employee benefit expenses. Okay, debit. Sir, why employee benefit expenses? So that's what your ICA is doing. You can also write it as employee compensation. No worries. Two things we are creating. One is SBP reserve. The other one is SBP liability. Now SBP reserve is how much, Ray? 1,20,000. SBP liability 34 lakh 4,000. Total it up 35 lakh 24,000 will be the total employee benefit expenses. Chalo. Now 31st March 20x0 is done. What is the next date? Sorry, 31st April, December, right? 31st December. They have taken it as calendar year. Why did I write 31st March? Anyways, 31st December 20x1. Next one. All right, Anna. Can we do the entry directly? Okay. Okay. I'll do the calculation separately. Don't worry. Copy, paste. First, equity settled options. Pretty simple. You guys know it. What should I do? 3,60,000 into 1 by 3. 1,20,000. Nothing much to discuss over here. Anyway, it's gonna be easy every single year. Correct? Cash settled option expense for this particular year. What you will be doing? So the number of options, which is 74,000. Employees 1. So 1 into, not necessary, into, right? Latest fair value 140. Correct? Into vesting period completed is 2 divided by total vesting period is 3 minus previous year recognized expense is how much? 34 lakh 4,000. 34 lakh 4,000. How much it comes? Anybody can give me the number, Nana? Do the calculation. Give me the number. How much? 35 lakh 2,667. All right. Right. So now we shall pass the entry. Pretty much same entry, correct? So I'll just copy paste. Only numbers have to change. Okay, SBP reserve, it is the same, 1,20,000. SBP liability, 35 lakh 2,667. Employee benefit expenses, total of this, how much, Nana? Total it up and tell me. Right, 36 lakh 22,667. All right. Chalo, that's it. We're done with the next year. Now let's move on to the next year. Next. 31/12/20x2. Right. Same calculation. Okay. What about equity settled option expenses? 3,60,000 into 1 by 3. That will be 1,20,000. There is no change in this, right? Cash settled option expense. What about that? Exactly. Number of employees is 1 into number of options is 74,000 into latest fair value is 147 into vesting period completed is 3, total vesting period is 3 minus previous year recognized expenses are how much? 34 lakh 4,000 in the first year plus last year 35 lakh 2,667, which is equal to, can anybody give me the number? Okay, how much? 39 lakh 71,333. Others confirm whether this is correct or not. 39 lakh 71,333 it seems. Is that it? All right, then let's pass the entry. I just need to change the numbers. Cash settled 39,71,333. Okay, SBP reserve is constant every single year, 1,20,000. You total it up and tell me how much it comes. Okay, 40,91,333. That's it. All of you have got this? Hmm. Chalo Nana, I think we are done with this. Now, so what is this guy is choosing at the end of the year? Did he give anything? Nothing. Okay. Right. So which means what he is going to choose, nothing is given in the question. So therefore, what we'll do is that in case if he goes for equity option, what will happen? In case if he goes for cash option, what will happen? We'll go with both. Okay. Chalo. So if cash option is chosen, right? This is easy peasy. What you'll be doing, Nana? Whatever the SBP liability that we have created so far, okay, from that we'll be paying what? Cash or bank. So SBP liability to cash or what, Nana? Bank. How much is SBP liability that we have created? Right, guys. How much is the SBP liability that we have created? There are two ways of calculating this, Nana. One way is, see here. I'll give you the usual way as well as the easiest way. Very simple. We'll be starting with this. 39,71,333 plus 35 lakh 2,667 plus 34 lakh 4,000. You add that, you'll get a number. That is the SBP liability that we have created, which is obvious. Or what is the latest fair value that we have got? 147 into number of options is 74,000. Directly multiply, you'll get the same number. 147 into 74,000. 1 crore 8 lakh 78,000. Which means how much you'll be paying? 1 crore 8 lakh 78,000. Right? And whatever that is there in SBP reserve, what you'll do? You'll be transferring that to what, Nana? Retained earnings. This also we know. How much is there in SBP reserve? Very easy, 3,60,000. Every year we have been taking 1,20,000, 1,20,000, 1,20,000. Correct? See, this is a shortcut. If you don't want this also, what you'll do? You'll go with the usual way. 39,71,333 plus 35 lakh 2,667 plus 34 lakh 4,000. Your number will be exactly the same. Okay. Because anyway, we are increasing the liability based on latest fair value only. Na? So therefore, you take the latest fair value and multiply with number of shares. Anyway, it will match. You got the point? Because we don't have employees issue over here. That's why. Otherwise, okay, the best way is go with this. Whatever the liability that we have created. 39 lakh 71,333 plus 35 lakh 2,667 plus 34 lakh 4,000. Okay. Right. So if cash option is taken, then it's pretty easy. Why? Because whatever the SBP liability we have created, from that we'll make the payment to cash or bank. That's it straight away. And whatever the SBP reserve that we have created, it will be taken to what? Retained earnings. So this is very easy. But if equity option is chosen, then there is a problem. Chalo. Next heading will be that only. If equity option is chosen. Now you can ask me, sir, why are you taking both the options? Because in question it was not specific, Nana. He did not tell you whether that so-called employee has gone for equity option or cash option. Therefore, we have to show the answer for both. In examination, if you get a situation like this, will you be going for either of the options? You have to show yes. You can't go with a presumption saying that it is presumed that the employee has chosen cash option. It is presumed that the employee has chosen equity option. We cannot say like that. Okay, right? Anyways, you guys are ready? So what is the first step we have to do? Whatever the share based payment liability that you have created, because you have done the accounting based on SAR option only, therefore you have huge amount of SBP liability with you, and that SBP liability should be transferred to SBP reserve. That is step 1. Chalo. SBP liability should be transferred to what? SBP reserve. Okay. Now what is SBP liability that we have got? 1 crore 8 lakh 78,000. 1 crore 8 lakh 78,000. literally will be transferred to what, Nana? SBP reserve. Correct? Yeah? So 1 crore 8,78,000 literally will be transferred. Ho gaya. Now what will be your SBP reserve? Already there is 3,60,000 in SBP reserve, correct? Plus from SBP liability, this much is transferred to SBP reserve, which means your SBP reserve will be, so new SBP reserve balance is equal to, already there is 3,60,000 plus 1 crore 8,78,000 which we have transferred just now, which means it will be how much? 1 crore 12,38,000 will be the balance. Now with respect to this part, your ICAI answer is wrong. It is wrong, that's all. We can't do anything. Okay, I'll show you that as well. Now what I have to do? From SBP reserve, now you'll be transferring it to what? Equity share capital as well as securities premium. That will be your entry. Chalo, let's pass on the entry. So SBP reserve to equity share capital to the extent of face value to securities premium. How much I'll be debiting SBP reserve? 1 crore 12,38,000. To this extent, you will be debiting to equity share capital and SBP reserve, right? Sorry, to securities premium. Now, you people tell me. Okay, to the extent of face value, it will go to equity share capital, right? Do I know the face value? 100. Chalo. So, this will be 100 into how many shares? 90,000, right? So, this will be 90 lakhs, okay? Everybody. So 1 crore 12,38,000 minus 90 lakhs. 22,38,000. So 22 lakhs 38,000 will go to what? Securities premium. Obviously, this is balancing figure. That's it. So this is your answer. Finish it off. Are we done? Now, with respect to your ICA answer, the final answer will tally for us. Whatever that we have written, this final answer will tally. But the steps in the way he has done, that is wrong actually. I've given in your solutions book as well. Where is it? So here it is wrong. Why? Because if you can see, from share based liability, directly he has transferred that to share capital as well as securities premium. You understand the point? To the extent of face value, directly he has put share capital and the balancing figure has been transferred to securities premium. And share based payment, whatever the reserve that you have got, 3,60,000 has been directly transferred to securities premium. Now, if you total it up, your answer actually matches with your ICA answer. For example, securities premium, ultimately your ICA has transferred how much? 18,78,000 plus 3,60,000, which will match with our answer, which is 22,38,000. And to equity share capital, how much has been transferred? 90 lakhs. So ultimately the answer will match. You get it? But the way your ICA has done it is not correct. So because the concept is, what IND AS says is, first you should be transferring it to what, Nana? SBP reserve. And from SBP reserve, you should be transferring that to what, Nana? Equity share capital, and the balancing figure eventually will go to securities premium. This is the procedure. So we have to follow the procedure. Are you able to understand? Got it? Any doubts? All right. Shall I go to the next sum? Right, Nana. Let's move on to the next one. Take illustration 7. Illustration 7. Moving on to illustration 7. Now, this is based on equity settled only, but non-market condition. Remember, this will not be there in your examination hall. So read the question as if this does not exist. Okay. Right. Moving on. Ankita Holding Incorporation grants 100 shares to each of its 500 employees. So number of shares is 100. How many employees we have got? 500. On 1st January 2001. Okay. 20x1 will just for ease of understanding, we'll keep it as 2001. The employees should remain in service during the vesting period, service condition. The shares will vest at the end of the first year if the company's earnings increase by 12%. If the company's earning increase by 12% means this is a performance condition. To be specific, it is a non-market condition. Okay. Next, second year, if the company's earnings increase by more than 20% over the 2-year period. Okay. Third year, if the entity's earnings increase by more than 22% over the 3-year period. The fair value per share on the grant date is 122. Grant date fair value. Okay. In 2001, the earnings increased by 10%. Happy. And 29 employees left the organization. Okay, because the condition was 12% and it has got increased by only 10%. There is no options vested over here. So we will go to second year. Naturally, that is expected. Na? Obviously, if the condition is satisfied, it will vest in the first year itself. Then all these things will not work out. Anyways, earnings increased by 10% and 29 employees left the organization. Okay, 500 is the gross. The company expects that the shares will vest at the end of the year 20x2. Okay, they're expecting that it will vest at the end of second year. The company also expects that additional 31 employees will leave the organization. Okay, so these three lines, what does it represent? It represents what happened in first year, and expectations of future. Expectations of future means at the first year ending when they are standing, what are they expecting about the second year and future? So that is all about these three lines. Okay, now let's see what has really happened in the future. In the year 2002 or 20x2, and that 440 employees will receive their shares at the end of the year 20x2. At the end of 20x2, the company's earnings increased by 18%. That also did not work. Therefore, the shares did not vest. So these two, fourth line and fifth line is talking about what actually happened in 20x2. Actuals of 20x2. Then what else? As expected, it will vest only in the third year only. That is common sense, we can easily expect. Therefore, the shares did not vest in second year as well. Only 29 employees left the organization during 20x2. So which means this third line also put together actuals only. Okay. Right. What else? Company believes that additional 23 employees will leave in 20x3. Now, at the end of second year, they're predicting third year, okay? And earnings will further increase so that the performance target will be achieved in 20x3. Fine. At the end of the year 20x3, only 21 employees have left the organization. Assume that the company's earnings increased to desired level and the performance target has been met as we have expected. In third year, the condition is satisfied. So, which means third year, the options has been vested. Determine the expense, that is option expense for each year, and pass appropriate journal entries. Good question, but nothing new. It is pretty much similar to the first 6 questions we have done, na? Kind of a similar model. That's it. Nothing new. Okay. You read the question. I'll give you a minute. After that, we'll start solving. Right? Read the question, Anna. Shall we start solving? Right, Nana? I hope you're done with your reading. Chalo, let's start solving. This is illustration. Seven. You guys are ready? Okay. Now, as usual, we'll start with the option expenses for year 1, that is 20x1, okay? And then 20x2 and then 20x3. I think in this question also it is like a calendar year only, because it grants 100 shares to each of its 500 employees on 1st Jan 2001 or 20x1. Okay. So which means it is pretty much like a calendar year. Okay. All right. Right. In that case, what we'll do, we'll write the dates first. 31st March 20x1. Sorry. Why am I going March? It is there in the subconscious mind. Even though I know it's a calendar year, which means it has to be December, by default my pen is writing 31/3 also. Anyways, right. Chalo, now what we'll do is that we'll do the expenditure calculation, that is option expenses, and then immediately we'll write the entry. Okay. Ready? Chalo. First one will be option expense is equal to number of employees. Now we are at the end of the first year, that is on 31st December 20x1 or 2001. How many employees do we have? Okay, I have to show you the question. Let's have a look into that. Now see here. As I told you, these three lines, they belong to the first year, correct? In 2001, earnings increased by 10%. Okay, options are not getting vested. 29 employees left the organization. Okay, but according to the formula, what is the formula, Nana? Number of employees who stay in the company at the end of the vesting period. So first year 29 guys have left. Okay, what about second year and third year? The company expects that the shares will vest at the end of, okay, additional 31 employees will leave the organization. Correct? 29 has actually left at the end of first year. We are standing at the end of first year and we are expecting that further 31 will leave. So which means what we'll do? Number of employees at the end of the vesting period, which is 500 minus 29 has left at the end of first year. You are expecting further in future that how many people will leave? Further 31. That is next 2 years put together. We are expecting that 31 will leave. Clear? So this is the number of employees that you are expecting at the end of the third year or at the end of the vesting period into, okay, number of employees into shares per employee. How much? 100 into fair value of the option on the grant date. What is the fair value of the option on the grant? See, every time I can't show you the solution. Sorry, question. You guys anyway have the question in front of you now. You can just look at it. 100 shares. Okay. Fair value per share on the grant date is how much? 122. That's what I'll be taking. 122. Done. What else? Into vesting period completed 1 divided by total vesting period. Now comes the important part. Now see here. Guys, we are standing at the end of year 1. At the end of year 1, what was your anticipation according to the question? Do you think the options will be vested at the end of the third year or options will be vested at the end of the second year? According to the question, because we have read the question already fully, the question has been read, therefore we know that the vesting period is 3 years. There is no doubt in that. But that was not your opinion when you are standing at the end of the first year. You look at the sentence over here. The company expects that the shares will vest at the end of year 20x2, which means standing at the end of first year, we are anticipating that next year itself the options are going to get vested. You understand the point? So as of now, what is my thought process? In reality, what has happened? That is a later period of time. As of now, when I'm standing at the end of year 1, I'm anticipating that my options will get vested at the end of year 2. It is clearly given in the question. Therefore, which means total vesting period according to you is how much? Total vesting period according to you is how much? 2 years only, not 3 years. 2 years only, not 3 years. Okay. Minus expenditure recognized in the previous year is 0. So number of employees will be 440 into 100 into 122 into 1 by 2 minus 0. So what will be the expenditure, Nana? Anybody is there? You can just calculate and give me the number. 440 into 100 into 122. 26,84,000. All of you got the same? All right. Let's pass on the entry then immediately. So what is the entry none? Obviously, employee benefit expenses or employee compensation, correct? Which will be eventually transferred to P&L account debit, that is implied to SBP reserve, obviously, because it is equity settled. How much is that? 26 lakh 84,000. Here also 26 lakh 84,000. Are we done with this, guys? Chalo. So 311220x1 is done. Next one is 311220x2. 31st December 20x2. All right. Let's look at the option expense now. Option expense is equal to, now, interesting. Now, see here. We know that the gross number of employees is 500. That we know. Minus. Okay. Let's look at the information over here. Now we are standing at the end of year 2. Now we are standing at the end of year 2. At the end of year 2, companies, okay. At the end of year 2, companies' earnings increased by 18%. Therefore, shares did not vest. Only 29 employees left the organization during 2002. Okay. So, which means in the first year, how many employees have left the organization? 29. That is first year. Now you are standing at the end of year 2. So which means you know actual number of employees left in year 1, you know actual number of employees left in year 2, and you have to expect how many employees you are going to leave in year 3. Why? Because when you are standing at the end of year 1, you thought that options will get vested at the end of year 2. Therefore, you have reduced the actual number of employees that have left the company in year 1 and expected number of employees that will leave the company in year 2. Clear? But once you have come to year 2 ending, you have anticipated or you are expecting now that the options will get vested in year 3 because it did not vest in year 2. Now, because you are anticipating that the options will get or the shares will get vested in year 3, which means at the end of year 2, which you are standing right now, you know the actual number of employees left in year 1, you know the actual number of employees left in year 2, you are anticipating the number of employees that is going to leave in year 3. Now the question is, how many number of employees left in year 1? 29. How many number of employees left in year 2? 29. Clear? So 29, 29, 58. How many employees you are expecting that they will leave in year 3? Additional 23. You understand the point? Again I repeat, last year you were standing at the end of year 1. So because you are standing at the end of year 1, you know what is the actual number of employees that has left in the year 1, which was 29, and you are anticipating that the options will get vested in year 2. Therefore, the number of employees that you are expecting to leave in the year 2, that also we have taken. Now you have come to year 2 ending, options did not get vested. So now you know that options will get vested at the end of year 3. So because you are standing at the end of year 2, you know what is the actual number of employees who has already left in year 1, which is 29. And you also know what is the actual number of employees who have left in year 2, which is again 29. And because you know that options will get vested in the year 3 and you're standing at the end of year 2, you should expect how many employees are going to leave your company in year 3, which is 23. 23 is expectation. So finally what you should do, 500 minus actual in year 1 29 minus actual in year 2 29 minus expectation in year 3, which is 23. Right. Minus 29 minus 29 minus 23, which is expectation of year 3. Got it? Into number of shares is 100 into what is fair value Nana on the grant date 122 into vesting period completed to total vesting period right now it is 3. When you are at the end of year 1, you were expecting that options will get vested at the end of year 2. Therefore, the vesting period was 2. But right now, because you are anticipating that options will get vested in the year 3, therefore, the vesting period is 3 and not 2. Minus expenditure recognized in the previous year, which is 26,84,000. Okay, that is equal to number of employees 419 into 100 into 122 into 2 by 3 minus 26,84,000. That's it, huh? Right, 419 into 100 into 122 into 2 divided by 3 minus 26,84,000. 7,23,866.666. 7,23,867. All right. So what will be your entry? Same entry. Entry will not change. Okay. Let's copy paste. Only the number will change. Array here. Copy. Paste. Let's change the number. 7,23,867. That's it. Done. Next date. 31st December 20x2 is done. 31st December 20x3 is the next date. All right. Now, as usual, first we'll start with option expenses, correct? Hello? Option expenses is equal to. Now, first thing we should know is number of employees. Do I know number of employees? Now, you are standing at the end of year 3. You are standing at the end of year 3. At the end of year 2003, only 21 employees have left the organization. So, 21 employees have left in year 3. This is actual. Year 2 actual 29. Year 1 actual 29. So, because you are at the end of year 3, you will know what the actuals are of year 1, of year 2, of year 3. So, we'll take that only. Minus 29, minus 29, minus 21. Chalo. 500 minus 29, minus 29, minus 21 into 100 shares only, na? Into fair value on the granted is 122 into vesting period completed is 3 divided by total vesting period is also 3 minus expenditure recognized in the previous years, which are 26,84,000 plus 7,23,867. That is this one as well as this one. Correct? Chalo, which is equal to 421. Correct only, na? Okay, 421 into 100 into 122 into 3 by 3 minus 26,84,000 plus 7,23,867, which is equal to, let us see how much it's gonna come. 421 into 100 into 122, okay, minus 26,84,000 minus 7,23,867, 17,28,333. Let's pass the entry, copy paste. 17,28,333. Correct? That's it. Now we have come to year end and the options are also getting vested because it is given in the question. So therefore, let's pass the entry. Once the option gets vested, what will be the entry? Share based SBP reserve, share based payment reserve, you have to debit. 2, equity share capital and securities premium. Is the face value is given? Face value, I don't think it is given. So if face value is not given, what we'll do? 2 equity share capital slash securities premium. Okay. How much is the amount when it comes to SBP reserve? We'll calculate in the usual way. Third year it is 17,28,333. Correct? Or if you multiply this figure also, you'll get the same number. That's okay. We'll calculate in the usual way. 17,28,333 plus 7,23,867 plus 26,84,000. 51,36,200. 51,36,200. Even if you multiply this also, you'll be getting the same thing. Okay, I'll write here, or you can calculate like this also, which is last year 421 into 100 into 122. Even if you multiply that, you'll be getting the same number. Okay, whichever way you want, you can do. Chalo. Are we done with this? Just present it the way we are doing it in the class. You need not do anything special in the examination. Okay, I have taken care to ensure that your answers will match with the ICAI answer, so don't worry about that. You can also look at your ICAI answer over here. This calculation, they have done it differently. One thing I don't know is, already they have done the calculation over here. Again, they have given working note over here. That one thing I don't understand, but that's okay. Any one is enough. Then these are all the entries, which is quite a bit normal. Chalo, let's go to illustration 8. Illustration 8. Ready? Yeah? Right, Nana. ACC Limited granted 10,000 share options to one of its managers. Okay. Again, it's a special person over here. For one manager, he gave 10,000 share options. In order to get the options, the manager has to work for 3 years service condition and reduce the cost of production by 10% over the next 3 years. By 10% over the next 3 years. All right. Okay. So, non-market condition, but it is a performance condition, comes under non-market condition. Fair value of the option on the granted, which is important for us, which is 95. Cost reduction achieved. First year 12%. Okay. Second year 8%. Third year 10%. How the expenses would be recorded? Okay. That is the question, Anna. Just read the question. Done with your reading, guys? Chala, if you could look at this question carefully, how the expenses would be recorded, that's what he has asked. Did he ask you to pass any entries? No. So we'll just be focusing on the expenses, which means on the numerical part. We'll not be focusing on the, yeah, exactly, entries and all that stuff, right? Now, so he says, if you want these options to get vested, then obviously the cost of production must reduce by 10% over a period of 3 years. Okay, which means on an average 10% for over a period of 3 years. First year they have achieved the condition, no worries. So obviously options will get vested. You can continue with that. But second year it did not satisfy. And also when you are standing on the second year ending, you are not expecting that it will vest in future as well. This is very important. This sentence is very, 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 very important. You understand the point? Second year you did not achieve, and you are also not expecting that to be achieved in third year as well. So which means what you will do in second year, you will reverse whatever you have done so far, you will reverse and you will credit it back to P&L. Why? Because it did not achieve the condition in second year and you are not expecting that to happen in third year as well. Then third year actually it has happened. Then what you will do? Again you will debit everything. You got the point? That's how it's gonna work. We'll see. Simple question. Illustration 8. You guys are ready? Okay, so no need to do any, what do you call, no need to pass any entries. So we'll do the calculation fair and simple. So I'll have year as one column, computation as another column. Okay. Fair value of options as one column. Right. Now, year 1. What is happening in year 1? You people tell me. Is it going to be vested? Yes. There is only one employee. So when there is only one employee, do I need to write that? Number of employees expected at the end of the vesting period, obviously single employee, into number of options vested, 10,000 given in the question, into fair value of the option on the grant date, 95. Okay. Into vesting period completed, 1, divided by expected vesting period, or total vesting period is 3. Okay. Minus expenditure recognized in the previous year, 0, which means what is the fair value of the options vested? 10,000 into 95 by 3, to put it simple. 3,16,667. Clear? Now year 2, what you will do? Same stuff. Same stuff. Huh? In year 2, did the condition get satisfied? Nope. Standing at the end of year 2, are you expecting that the condition will be satisfied in year 3 as well? No. because it is clearly given in the question. That so-called condition to achieve 10%, it was not fulfilled in year 2, and there was no expectation that this condition will get vested in the year 3, which means it will be fulfilled in year 3. When you're not expecting to qualify, or in the sense satisfy the so-called non-market condition of that 10% every single year, then obviously you're not satisfying this total vesting condition. When you're not satisfying the vesting condition, you are not getting vested. Options are not getting vested. Is that clear? So therefore, you did not satisfy the condition in year 2. Neither you did satisfy the condition in year 2, nor you are expecting to be satisfying in year 3 as well. So which means you have to reverse. Now see here. Since non-market performance condition of 10% was not fulfilled in year 2, and no expectation to fulfill in year 3. Hence, earlier expense recognized in year 1 is reversed in year 2. So you're not expecting that it will be vesting in year 3 as well. Correct? So the condition is not fulfilled in year 2, and also you're not expecting that you will fulfill the condition in year 3, which means there is no question of options getting vested, which means what you have to do, reverse whatever you have done in year 1. Chalo, in that case, what you will do? This so-called 3,16,667 will be reversed. Reversed means you will make it 0 eventually. Therefore, you will reduce that much. Now it is 0. Now it is 0. Coming on to year 3, all of a sudden now it is satisfied. So therefore, all the expenses, the fair value of the options will be vested in year 3 only, which means one employee into 10,000 options into fair value of the option on the grant date into vesting period completed divided by total vesting period minus expenditure recognized in the previous years, or 0. Why? Because whatever you have recognized in year 1, you have already de-recognized that in year 2, which means whatever that you have recognized is 0. So which means the entire expenditure will be recognized in year 3 itself, which means 95 into 10,000 into 3 by 3 is 1 only, na? So 9,50,000 will be debited to the P&L in year 3 itself. Okay, so I'll write the reason here. Since in year 3 the non-market performance condition is met, hence all expense will be charged to P&L this year itself. Got it? Chalo, that's it. See, when you are solving these kind of questions, Nana, where he did not ask you to pass any entries, and you are trying to just put the numbers, then when there is any reasoning, see here it is a special reasoning, right? You are reversing the entire expenditure. So why are you reversing? It has to be clearly explained. If you don't explain this, then you will not get marks in the exam. Am I clear? Here also the same logic goes. Now all of a sudden you are recognizing the entire expense in year 3 itself. You got the point. In that case, you have to write the reason. Why are you doing that? Otherwise, you are not going to get marks in the examination. Clear? Chalo, finish it off. We'll move on to the next one. Guys, finished? Nana, finished? Sure. Now let's move on to the next one. Illustration 9. This will be the last sum of this particular session, okay? Illustration 9. So this is market based condition with time limit, okay? Chalo. Now, Apple Limited has granted 10,000 share options to one of its directors for which he must work for next 3 years, and the price of the share should increase by 20% over the 3 years. Price of the share, so obviously market condition. By 20% over next 3 years. First year satisfied, second year nope, third year yes. At the grant date, the fair value of the option was 120. How should we recognize the transaction? Kind of similar to the previous question. Here also there is only one guy who is a very key personnel who is the director over here. Now you tell me how to solve this particular question. Here also he is asking you how to recognize the transaction. That's all. Read the question, Anna. We'll start. Ready? Okay, I'll wait for another 20 seconds. After that, I'll start. Nana, this question is pretty much similar to the previous question that we have done, Nana. Okay, here also first year it is achieved, second year it is not achieved. Here also first year it is achieved, second year it is not achieved. But he did not tell you what is the expectation at the end of second year. Okay, but the only difference is previous year it was previous question it was non-market condition. This question it is market condition. That is the only difference. Everything else is same. Chalo, shall we start solving? Illustration 9. Ready? Okay, first we'll start with year 1. Option expense is equal to number of employees at the end of the vesting period. How many employees you're anticipating? Obviously one employee. So even if you don't take one also, kuch farak nahi padta. One employee into how many options, re? 10,000 share options. 10,000 share options into fair value on the grant date 120. Okay. Into vesting period completed 1 year divided by total vesting period expected 3 years minus expenditure recognized in the previous year 0. So which means how much will be the option expense in the first year? 10,000 into 120 by 3. 12 lakhs. So 12 lakhs by 3, 4 lakhs. Why to do calculation? 4 lakhs. Are we done with this? Now coming on to year 2. Option expense is equal to, sir, just like the last sum, sir. In last sum also first year we have recognized. Second year what has happened? Non-market performance condition of 10% was not fulfilled in year 2. Right. Similarly here the market condition of 20%. Yeah, 20% is not fulfilled in year 2. So therefore what we'll do? We need to reverse it. Yes, sir. Everybody. Yes. No, Ray Mokku fellows. No. Exactly same expenditure you will recognize. Into 2 by 3 minus expenditure recognized in the previous year. This will also be 4 lakhs. Okay. Third year also you will be doing the same stuff. Those who have read the concepts that I've taught you properly, those who remember that, they'll not have any doubt why I'm solving it like this. Correct? Those who have not revised whatever I've taught you so far, you guys will have a problem. That's it. Problem is done. Why, sir? You should know the answer. Why? It is market condition. When it comes to market condition, what did I tell you? When it comes to market condition, whether that condition is satisfied or not satisfied, both the possibilities are considered at the beginning itself while calculating the fair value of the option on the grant date. When it comes to market condition, while calculating the fair value of the option on the grant date, both the possibilities of the market condition getting satisfied and market condition not getting satisfied is considered already. Therefore, in future, even if the market condition is not fulfilled or not satisfied, there is no requirement for you to reverse the expense which you have previously booked. This has been clearly taught. Correct? When the time comes, you guys have forget, isn't it? Mokko fellows. Chalo. Since it is market condition both the possibilities of price of the share getting increased by 20% over next 3 years and not getting increased by 20% is also considered while calculating fair value of option on grant date. What is that in this question? 120. So, therefore, even if the required market condition is not fulfilled, okay, there is no need to reverse the expense previously booked or previously debited in P&L account. Got it? This you should have remembered the moment we are talking about market condition and market condition not getting satisfied. I've taught you multiple times. Immediately you should be able to connect and you should be able to give me the right answer. But if you guys gave me the wrong answer, then it means that you did not revise properly. Chalo, anyways, that's it. We are done with this. Take it down. Any doubts? Right. Chalo na.